Good afternoon, ma'am. We are the group 4 and we're going to topic about the chapter 8. The first topic is the money market. The money market, this is the first topic we're gonna discuss about it. Much of the US economy relies on the scale and efficiency of the money markets. This is one of the most important financial markets that keeps our US government and our local governments and agency and cooperation banks, other financial institutions, and broker-dealers functioning smoothly for the benefits of its stakeholders and clients. The U.S. money market include the capital market, debt instrument, topic, federal fund market. The federal fund market or Fed fund market is used by the banks for borrowing and lending the bank's reserves. The Fed banks market is central to the overnight market for the credit banks in the United States. This includes that the Federal Reserve seeks to influence its target Fed fund rate through its execution of monetary policy to achieve its stationary objective for monetary policy maximum employment. The next one is the repurchase agreement. The repurchase agreement transactions, or what also known as the repo, is the sale of securities to a repo investment, an agreement by the seller to repurchase the security on establishment future date at the fixed price that includes accrued interest to that date. Repo transaction is essentially a secured loan of cash collateralized by the security acceptable to the cash lender for a term of rate manually agreeable by the counterparties. So the next one is the treasury bill, or what we call its bill. The treasury bills are the short-term security issued by the U.S. Treasury that mature in 1 year less from the other issue date. T-bills, this is also known as T-bills, and other long-term debt are used to fund our federal government or finance other debt. It is mature. T are the backed by the full faith and credit by the U.S. So the next one topic will be going to report by Mr. Jose.
So next is the government-sponsored enterprises federal agency securities. Government-sponsored enterprises, or GSEs, more commonly known as federal agencies, are financing entities set up by the Congress to make loans to specific groups such as farmers or homeowners. Government money market funds are defined as money market funds that invest 99.5% or more of their total assets in very liquid investment, namely cash, government securities, and or repurchase agreements that are collateralized fully with government securities. Next is the commercial papers. Commercial paper, or CP, is a short-term, unsecured promissory note issued primarily by three issuer types. One is corporations, two is financial institutions, including banks, and last is the special purpose vehicles funding high quality assets, also known as asset-backed commercial paper, or ABCP. Commercial paper is a short-term, unsecured debt instrument issued by corporations, typically for the financing of short-term liabilities. Next is certificate of deposit. Certificate of deposit is a bank obligation payable on a specific maturity date. Funds are deposited with the bank by investors for a specified period of time during which the funds will earn interest at a specified interest rate. Certificates of deposits are issued to investors by banks. The investor lends the institution money for a predetermined amount of time, and in return they get a set rate of interest. Next is retail CDs. Retail CDs are considered low-risk investments since the Federal Deposit Insurance Corporation or FDIC guarantees up to brokered CDs.
An individual investor can also purchase a CD from a broker-dealer referred to as a brokered CD, although purchased from a different institutional CDs. For institutions and higher net worth individuals who invest in CDs excess of the FDIC insurance limit, the investor must analyze the creditworthiness of the bank. There are other rating services that rate banks as well. These firms often use formulas based on a variation of CAMEL analysis. CAMEL stands for capital, assets, management, earnings, and liquidity. Euro-dollar deposits. Euro-dollar are dollar-dominated bank deposit liabilities not subjected to U.S. banking regulation or under the jurisdiction of Federal Reserve. Municipal notes are notes, short-term obligation issued by municipalities to meet cash flow borrowing needs. Municipal notes are normally mature in a year or less and pay interest at borrowing maturity. In analyzing the creditworthiness of municipality, great emphasis is placed on cash flow ever since it is the primary source to repay the note. The most common types of municipal notes are tax anticipation.
And we'll proceed to the next topic, which is variable rated demand notes. A variable rate demand note, or BRDN, is a long-term tax-exempt municipal bond. Maturities can be as long as 30 years. That is structured like a short-term and has long-term maturities of floating interest. Money market funds. Money market funds are the largest single category of money market inventory. How the financial crisis of 2017 and 2008 changes the money markets. The global financial crisis of 2017 and 2018 had a significant impact on the regulation and the subsequent market practices in the money markets. Conclusion. The global financial crisis of 2017 and 2018 profoundly changed much of how the money markets function.
That's all, and
Thank you.